Hi guys, today we're going to do our final lesson on inventory for Unit 3 accounting. So congratulations to getting the end of this mini unit. We're still on chapter 9, pages 185 to 188, and we're going to focus on a concept called net realizable value and inventory write-downs. If we have a successful lesson, you will leave being able to value inventory using cost, which we've already really done, using period and product costs and identifying the cost price. But being able to value inventory using its net realizable value, and will be able to do these things. So this will be your success criteria. You will be able to define the term net realizable value. You'll be able to say, I can record an inventory write-down in inventory cards, general journal, and general ledger. You'll be able to explain the impact of an inventory write-down on an income statement and explain the impact of an inventory write-down on an accounting equation. So pretty standard success criteria, but what we really need to do is understand what the hell we mean by net realizable value. Net realizable value comes down to this question here, or this statement here. Inventory, as you know, is usually valued at cost price. The cost price being the purchase price plus all the costs to get the inventory into the condition and location ready for sale. And we record it at cost price and then mark it up to maybe 100, 150%, whatever it is, to earn a profit. Sometimes, and we don't want this to happen, management is forced to sell its inventory below its cost price. So it's making a loss. Obviously we don't want to do that, but it happens. Why does this happen? You might want to have a think about before you keep going this video and pause this video. Why does it happen? Lots of reasons. These can include the inventory is damaged. I'm sure you've been into any store and seen this is the product that's discounted because it's got a certain amount of damage from it. It might be near its use by date. It's something that goes off. You go into the supermarket, things are cheap when they're near their use by date. Could be superseded by a newer model. For example, the iPhone goes down in value once a new model comes out, just like any other technology. It could become technologically obsolete. This is different to having a newer model, just there is a different type of technology which makes the one that you're trying to sell not as valued by customers. So an example, and I'm going to show my age here, VCRs and DVD players don't really exist anymore because we now stream. So as soon as streaming started to kick off, those products lost their value. And it could just also be just out of season. So you go into a clothes store, I'm making this video as winter is coming, all those summer clothes are starting to become much cheaper because they're out of season. Any of these reasons might be a reason why a business would reduce the cost of the sale price of their inventory, and sometimes this might go below what they actually bought it for. Some industries, management will also pick a few items to be below cost as a marketing strategy to get you in. I don't know if this is for a fact, but you might think supermarkets, what are some really cheap products that you know in the supermarket that seem too cheap? Milk, $1 a litre, it actually costs more than that to make, but they want you to come in for the cheap milk and buy other things, so they're happy to make a loss. This then comes down to this concept of net realizable value, and we like to think of it as cost versus net realizable value, because net realizable value is only really relevant if it is losing the battle versus the cost price. And I'll explain that a bit more later. As a basic rule, inventory is always recorded at cost price, and you've become an expert at recording in the inventory card at cost price. But there is an exception when reporting inventory in the final accounting reports, when this issue happens where we're selling it below cost. To to avoid breaching the faithful representation qualitative characteristics. So if you're asked a question on this in Saxon exams, faithful representation is generally the characteristic to talk about. Inventory must be valued at the lower of the cost and the net realizable value. What do I mean by net realizable value? And we're going to go through a couple of examples. It is the estimated selling price minus any direct selling expenses. Really important to write in your notes, this is your definition. What do I mean by direct selling expenses? Any costs incurred in the selling, marketing, or distribution of that product. So what is net realizable value? It is the net amount that the business expects to gain from a sale. What are they actually going to make from the sale? So when I say net realizable value, what we're talking about is how much am I going to sell my inventory actually for, minus how much is actually going to cost me to do marketing, deliver it, so distribution is delivery, all those sorts of things. If we look at this net realizable value and realize it is less than the cost price, then we have to record our inventory at that value. And that meets our faithful representation characteristic that says that we should faithfully represent what is happening in our business. So we can now define the term net realizable value, and now that's a good time to really pause and update your notes. Just as a reminder, we've come back. Net realizable value, what is our definition again? It is defined as the estimated selling price of an item less any costs incurred in the selling, marketing, or distribution of the item. Let's do an example to calculate net realizable value. For example, we have a Bluetooth speaker. Its cost price, $150. Our selling price, $250. So we're doing a markup of about 160, 170%. I can't be bothered working it out. But we're selling it for more than its cost price. But we pay our staff a commission. If you're a bit unsure what a commission, each time we sell something, the staff get a little bit of money, and it's 10% of the selling price. So my question to you is, what is the net realizable value of each speaker? If we go back to the definition, you can see that net realizable value is the estimated selling price, and you might have that in your mind, $250, minus any selling expenses. So, what is our net realizable value of this speaker? $250, our selling price, minus 25, because it's going to cost us 10% of the selling price as a commission to our staff. So we're actually going to make net realizable value. We're going to make a value of $225 per speaker. We're not going to make a profit. We're going to make a profit of roughly $75 per speaker. Our net realizable value is greater than its cost price. So that's good news. Nothing is bad. If you look at our second dot point there, inventory is valued at the lower of cost and net realizable value. So we just value it at cost. We keep working on, move on. Our business is operating as it should. But let's think of an example. There are times when the NRV might be lower than the cost price. i.e. the business is selling the item for less than it cost, and all of those ideas like damage, out of season, technologically obsolete, a newer model, any of those reasons. When this happens, we must complete a record called an inventory write-down. An inventory write-down is a journal entry used to reduce the value of the inventory from its cost price. We need to reduce actually the value of our inventory because it's not faithfully representing what its value is anymore. And this ensures that the faithful representation is met. And we do this because losses on inventory must be recognised if they occur in the reporting period. Otherwise, our profits will be overstated because we're actually going to overstate our inventory value and overstate our assets as well. Let's do an example. Let's go through the process and then go through an example. This is the process you're always going to do when you're analysing, do I need to do an inventory write-down? The first thing you're going to do is determine the net realisable value of a product. Selling expenses, selling price minus the direct selling expenses. You're then going to compare the cost price versus the net realisable value. And you're going to identify the items where the net realisable value is lower than cost. Really just be careful here. It's not the selling price versus the cost. There might be a net realisable value. We're going to look at net realisable value, not selling expense. So I'll come to an example at the end of this where there's often a trick question. But we're going to identify where the net realisable value is lower than cost. And for just those ones where the NRV is lower, we're going to do a general journal to adjust the inventory to record an inventory write-down, and we'll update the inventory card. Be careful here. And the example, I think, in the next slide explains this again. Net realisable value is not the selling price. It is also the selling expenses incurred. So you could have an example where the cost price is $100 and you've had to reduce the selling price of your goods and it is $110. So the selling price is still more than the cost price. So you're going, sweet, I'm fine. However, let's say it's going to cost you $20 to do an advertising blitz per unit of inventory to sell all that because it's getting out of stock. So you need to, nearly out of date, it's getting a bit technology obsolete. You need to do an advertising blitz. Now our net realisable value is actually less than the cost price. If it's going to cost us we're going to make $110 per sale, but it's going to cost us $20 to sell it. So our net realisable value is $90. That is less than the cost price. So just be careful in your examples. So let's consider this speaker example from earlier. We had a cost price of $150 and a selling price of $250. Our commission paid to staff was 10%. And we had, let's say now, let's put a number to it. We have $100 in our inventory. Prior to something happening, we were making a net realisable value of $225 and we were fine. However, due to a new range of speakers being released, management has been forced to drop the selling price to $150 as they need to clear the shelves for the new model. Pretty common business practice. So what is the NRV? The NRV is now 150 minus 15, so 135, because we still have to pay the sales commission of 10%. So the cost price of one speaker is $150. The NRV is 135, so there is a difference of 15 where the net realisable value is less, so we need to do an inventory write-down. How many do we have? We have 100. So the adjusting entry means that we have $1,500 of inventory write-down. 100 units we have to write down by $15 each because they are now worth $15 less than the cost price. So we have 100 of them. 100 times 15 is $1,500. So we have an inventory write-down of $1,500. And you might remember an inventory write-down is a general journal entry. So how do we do this general journal entry? Prior to that, let's think about the effect of the inventory write-down on the accounting equation. Our assets are going to decrease because we're going to say our inventory goes down. You might be suddenly thinking, well, if inventory goes down as an asset, that might be our credit in our general journal entry. There is no effect to our liabilities, which means our inventory write-down, our owner's equity must decrease. How does our owner's equity decrease by inventory write-down increasing? What the hell? I've just told you owner's equity must decrease. How does owner's equity decrease when we have an increase in owner's equity? An owner's equity account? It must be an expense. So our net profit will decrease because we're increasing our expenses. So we apply a general journal entry like so. Our debit is going to be called inventory write-down. So we have a new ledger now called inventory write-down. It is a debit. So what is inventory write-down in terms of elements? It is an expense. Expenses going up are debits. And we know that our inventory is going down, which inventory is an asset. Assets going down is a credit. So in this example, we would put the value to it. $1,500 is how much has gone down, and we would have a narration like in this example. So just to finalize and confirm this before we go into inventory cards, which is our final slide, inventory write-down is an expense account. Inventory cards also have to be adjusted here because we're adjusting how much our inventory is worth. Inventory cards amalgamate into our inventory account in our general ledger. We do this write down in our inventory card by adjusting our out column because there is an out of an amount of value leaving our business in terms of inventory. The value is going to be the amount of the write down per unit, and the dollar is going to tell us how much that total value is. Probably easy to show in an example. In this example, let's say, and we had 100 speakers at their cost price of 150. We now have to reduce them to their NRV, which is 135. So how do we reduce the value from 150 to 135? We do 100 as our quantity with a value of 15 leaving our business, which then results in this total here. So in summary, for NRV, both our income statement and balance sheets are adjusted. The income statement is impacted because our inventory write-down is an expense and revenue expenses are in our income statement. Our balance sheet is impacted because our inventory goes down, and our owner's equity is impacted because of our profit figure, and we'll go through income statements a bit more later. We've now complied, because of this inventory write-down, with faithful representation, because we are faithfully representing our business to show more expenses, less inventory, less profit. You could also say relevance is impacted if you want to talk about another characteristic, because this is important because it's going to impact our decisions, because you're telling the business owners, decision makers, that our inventory value has gone down. Now we've got some important decisions to make. Thank you for listening today, guys. This is our last lesson on inventory. You are now experts. You should be able to pick up any past exam question in inventory and do most of it by covering after watching all of these videos, and hopefully by doing some textbook questions and updating your notes, you can say that you have achieved all of the success criteria in this video. Have a great day, guys.